Investments. Should you? Shouldn't you? What's best? And what should you avoid? They are all questions anyone who is considering investing will ask themselves. Being well informed is the foundation to making sensible investments, which is why I'm excited to welcome Matt Falla and Ian Leverington to the very first episode of Money Talks, a podcast series that will cover all things financial literacy. Matt, managing partner at Evelyn Partners, and Ian, an investment director, know a thing or two about investment management. So I'll be picking their brains today as we talk about investments for beginners. Thank you for joining me today, Matt and Ian. Let's start with you, Matt. Could you tell me about your role and responsibilities at Evelyn Partners?
So I'm the managing partner of the Jersey office, which is known as Evelyn Partners International. So in the office we have a team of investment managers and support who are managing money for individuals, trusts, companies in Jersey. And we also provide services to our UK managers who are booking client assets on the island as well.
Ian, what about you?
I'm an investment director at Evelyn Partners. Started fairly recently. Before that, I was an investment manager at various companies in Jersey. And I have a particular bent for ESG, sustainable investing.
Brilliant, thank you. So in layman's terms, I'll leave it up to either of you to decide who takes this one. Can you define what investing is?
Well, it always struck me as amazing that we do this every single day, yet I struggle at times to find a definition of it. So I did rely on AI to actually give me something. So in the words of AI, and then I'll put it into English, investing is the act of allocating money or resources into assets, businesses or opportunities with the expectation of generating returns such as income, profits or capital appreciation over time. So that's the AI version. For me, I think when we talk about investing, people think that it's anything other than holding on to cash. So cash in the bank, cash in your pocket. So it's anything that involves allocating that cash to something that is of a higher risk than cash, or that you have to lock away for a longer time than cash, and therefore you would expect to receive a higher return than cash for taking more risk or restricting access.
Great. Ian, anything to add there?
No, for me, that's exactly right. You're taking near-term risks for long-term returns.
So why should people invest?
Well, I think there isn't a should, because some people wouldn't like or tolerate the downsides that can come with investing.
Yeah.
But I think the general rule of thumb is to do with the effect that inflation has on money over time and how it essentially erodes the buying power of the pound in your pocket. So to give a real life Jersey example, so I'm just about to turn 50. Before I was born, my parents were looking at buying a house in Jersey, and it was a lovely granite place in St Albans High Street, and 4 bedrooms, garden, and at the time I think it was a shade under £6,000.
Wow.
Yeah. Now that property, and they didn't buy it by the way, now that property would be somewhere probably closer to £2 million.
Wow.
So if you imagine if they had taken that money and put it £6,000 under the bed and pulled that money out 50 years later, it would be pretty much out of date in terms of currency, legal tender, but B, they would be able to buy probably about half of a small car with that compared to a very nice house. Now, I'd also add to that, my parents, even back then, were not the sort of people to buy a £2 million house in 1975 money. So there's the impact of inflation. If you do nothing, over time will erode the spending power of your money.
Matt's explained it very well there. The primary reason for investing for me is to make sure that you've got enough money to do what you want to do when you want to do it.
Yeah.
As simple as that. And if you leave your money in cash, the chances are over the longer term you won't have enough money at the end of your time horizon to do what you want to do and to look after yourself in retirement.
Yeah. Well, that might lead nicely onto my next question, which relates to the misconceptions about investing. So, Ian, we'll go to you first. What are the most common misconceptions about investing, in your opinion?
The first one, I guess, is that people who aren't familiar with investing automatically think that they can lose all of their money. And you can, if you put it all on black, sure, you can lose all of your money. You go to an investment manager or you do your own investments on the basis that you don't put it all your eggs into one basket.
Yeah, I think it's the preconceptions are that it can be a quick way to either lose a lot of money or make a lot of money. That you need a huge amount of experience to do this, where actually there are professionals that can take that responsibility for you, that it is expensive, and actually now we're seeing the cost of having money managed professionally at sub 1% in a lot of ways. And I think that there is an innate preference in some people's minds between investing in the tangible, Jersey property, let's say, as opposed to the intangible stocks, shares, bonds. And I think they all have their pluses and their minuses, but we tend to look at things quite differently regarding physical property than we do a stock and share portfolio.
So leading on quite nicely to what you mentioned about it's a very real chance that you can lose your money when you invest. So what should you do to avoid that when you're investing?
So I think the level of risk you are prepared to take is proportionately linked to how much money you may lose in any 12-month period. So when we are looking to the client and we are assessing their attitude for risk, what we're really looking at is their capacity for loss. How much could they afford to lose in the short term for longer term gains? Because asset prices, by this I mean stocks, shares, bonds, fluctuate on a daily basis. But over the medium and long term, history will dictate that those asset classes will outperform cash and beat inflation, which is why people invest. So what we're making sure is that somebody's time horizon is long enough to weather those storms and the ups and downs of the financial markets. And secondly, that they're going to feel comfortable if they did look at their portfolio and see that it was 10% down. I don't think anyone feels truly comfortable seeing a loss, but knowing that that is part and parcel of the journey towards longer, more consistent long-time returns. So yes, if, as Ian says, you went to the casino and you put all your money on black, you have a very good chance of making 100% return in the space of 10 seconds. You also have the very real opportunity to lose that money in 10 seconds.
Yeah.
So it's being comfortable with the risk you take and dealing with somebody whose job it is and who has many decades, in unfortunate cases, many decades of experience in managing money. And the biggest thing, I think, the fundamental, is making sure that all your proverbial eggs are not in one basket. Yeah. So if you are going to invest, we look at a diversified portfolio across different companies, across different geographies, across different sectors, across different timeframes, so that if any one of those were to go sour, the impact on the total portfolio is far reduced compared to just picking a stock and putting everything into it.
Yeah, makes sense. Ian, anything to add about what you should avoid?
Yeah, I would say cryptocurrency, but there are plenty of people who would disagree with me on that one. Generally, in many walks of life, and it probably still applies to the investment world, if something looks too good to be true, if the returns look too good to the risk you're being told you're taking, avoid it like the plague.
Yeah.
Yeah, and I think to add on to that, avoid investing in something you don't understand. No matter the fact that we are professionals, we go to great lengths to ensure that when someone is investing, they understand what a stock is, what a bond is, how it performs, and why we're including it in the portfolio. And any reputable investment manager should do the same. Avoid short-term decisions. Investing is an incredibly emotional thing. as humans, we are hardwired to avoid risk and avoid loss.
Yeah.
And we regret decisions. So I have met people in my past who said, I tried investing once, it didn't work. Or I tried investing and the market fell and I sold, and then I invested again and it sold again. It's trying to avoid those understandable decisions to do what you feel is the right thing, but doing it at the wrong time.
So I think this next question leads quite nicely onto what was discussed there, because what I took from that was that having a good level of understanding of what you're doing forms the basis of any good decision when it comes to investing. So you've decided you want to invest. How do you know what's reputable when investing? So a company, an app, anything like that, a currency even. How do you know what's reputable and safe to invest in or work with when investing?
So I think you either invest your own time in investigating whatever that investment might be and come to your own conclusions about how reputable and safe it is, or you delegate that to someone whose job that is and who fundamentally, though, and importantly, you trust. And that trust can be as a result of the personal relationship you have with that individual, the jurisdiction they operate in, the strength of their regulator and the regulatory environment that says if this business is operating in Jersey and it holds a license provided by the Jersey Financial Services Commission, there are minimum levels of standard, of competency, of knowledge, of diligence, of care that you should expect in that. So I think act in haste, repent at leisure. No investment really, or very, very few, requires you to act quickly. And I think the phrase I like is, if there's doubt, there's no doubt. Be very, very careful about investing in something that you don't understand, don't know, or that, as Ian says, sounds too good to be true.
Yeah, makes sense. Ian, what about you when knowing what's reputable and trustworthy?
Sometimes it can be a little hard to identify reputable. If you're investing in stocks and shares, you know that you have a certain level of comfort that those companies are controlled on a central index. They've got to comply with certain rules to be on an index. So you have some inbuilt defence. Doesn't mean that the chief financial officer of a company can't be crooked and blow the company up, and that comes back to diversifying your investments. Sometimes people actively look for less reputable investments because there's a better return on offer. It really, we've said it 100 times already, but it really comes back to what your risk tolerance is. If you can diversify well and take and within each little investment take a lot of risk, you can maybe reduce your risk. Sounds like something out of a Wall Street film, but nonetheless, it probably is true. Understand what your level of comfort is, and then you can assess whether it's reputable enough for you.
So it sounds like it's unique to each person.
Yeah, the worst, I'll say no investment is worth laying awake at night thinking about.
Yeah.
That is happening, then you probably shouldn't be invested. And there are certainly times in our career where we have said to a potential investor, we don't think this is right for you.
So what are your top 3 tips for those just starting out in investing? They're interested, they don't really know where to start maybe. What are the top 3 bits of advice you'd share with them beginning that journey? Ian, we'll start with you.
Quickly and probably very flippantly, I'd say, don't touch it. If you're going to invest, don't keep taking money out of it. Leave it there, let it grow over the long term. Don't watch markets all the time. Don't get an app on your phone which tells you what the FTSE 100 index is doing every 5 minutes. You'll just scare yourself. Volatility is part of investing. Markets go up and down. Look at it once a year. That would be my best advice. And again, it's repeating what we've already said. Make sure you diversify your investments.
What about you, Matt?
My top 3. I think it's a Chinese proverb that says that the best time to plant a tree is 20 years ago and the second best time is today. So the sooner you can start investing, and by that I mean into a pension, into a regular savings scheme, the better. Little and often is absolutely a fantastic way to go, and there are a number of apps that will allow you to invest literally from pennies and round up you're spending in shops to the nearest pound, because the beauty of investing is the effect of compounded returns. So that 1% that goes back into a portfolio, or 5% next year, is a higher amount to start with, and so it builds on. So I think it's little often, and I think, to echo Ian's comments, leave it well alone. Set yourself, I think, at the start, what you believe a good return for that year would be. Write it down somewhere, stick it in a cupboard, and then pull it out at the end of the year and have a look at whether the portfolio's done that. Because it's amazing how our expectations will alter by the colour of the FTSE 100 or another market is on a particular day, whether we become, as is known, bullish, expecting the markets to rise, or bearish, expecting them to fall, will change on a second's notice. So really just look at what you'd be happy with, and then come back in 12 months and see if you actually were.
Excellent notes to end on. Great bits of advice there. Ian, Matt, thank you so much for your wisdom today, and thank you for joining me.
Thank you.